2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
As we enter the late innings of President Trump's first term in office, let's take stock of how his old stomping ground, that is the luxury real estate market in New York City, is faring. Well, we know that inventory is piling up as developers struggle to find takers for high-end properties. Pierre Debbas is managing partner of Romer Debbas, a firm that's focused on the purchase and sale of commercial and residential real estate in New York City. So do we blame the loss of the tax deduction for SALT states for those state and local taxes?
There's a number of different factors that have impacted the market, but namely in the SALT states, the loss of deductions has certainly been the biggest factor in the high-end residential housing market. Because when you take into consideration properties that have taxes of 10, 15, 20, up to $50,000, losing the ability to deduct those taxes is completely having a negative impact on valuations.
There's a story on the Bloomberg that published this afternoon about lots of inventory, particularly luxury condos piling up, so-called shadow inventory, thousands of units that aren't even on the market, but they're there depressing prices. Right. Why don't prices just adjust and come down and clear like a normal market's supposed to work in Manhattan?
Well, that'd be the logical thing, right? I think that it's a matter of just transitioning to that time period where developers reduce pricing even more. We started seeing it last year in the New York City high-end residential market. I can tell you, I have not seen transactions more negotiable in 10 years. So developers are coming around to the embracing the concept that we have to reduce pricing and provide greater concessions to increase traction.
When we talk about the potential impact that the current administration has had on the real estate market, not just here in New York, but really in a lot of the major cities here, you have to kind of talk about the effect of foreign buyers and their absence in some of these markets over the last couple of years.
Yeah, I mean, foreign buyers, especially here in New York, New York, California, Florida, so much of our demand was fueled by capital coming in from overseas. And with everything going on politically and like to your point in terms of high-end luxury product being a glut of supply, there's been a tremendous lack of demand and a sense of urgency from money from overseas.
What about low interest rates? Hasn't that added urgency to buying at least? Because, I mean, at least until the end of last year, we didn't know how long interest rates would stay low for.
Well, lower for longer, Scarlett. Lower for forever.
Yeah. So we had 3 rate cuts last year, and the Fed's gone on record saying they don't anticipate changing that in 2020. So that bodes very well for the housing market. But at the same token, you have a year where you have to worry about it, essentially, based off of the Fed's statement. So it's not creating that immediate sense of urgency.
You know, long term, or short term, there are all these issues, SALT and lack of foreign buyers, et cetera. And long term, it's cold here and there's warmer places to be, and there's probably a bunch of other reasons why it doesn't even make sense.
People are nicer outside of New York.
But on the other hand, we keep seeing announcements about big companies Amazon is adding more employees in Manhattan even after they didn't get that big offer, and Facebook and Google, they're all expanding. So the grand scheme of things, it's like, has New York just seen this several times before and still the fundamentals are pretty good?
The fundamentals are great to buy now. When we talked about unemployment being at record lows, stock market at record highs, interest rates we just discussed, the fundamentals are there. But when you're talking about, these corporations coming in and creating all these jobs, is that for transient occupancy? Are we talking jobs that are 1 to 3 years? Are we talking people that are going to be long-term New Yorkers where they want to buy property and invest here for the future?
When you have clients come to you, I mean, what do you tell them, given the current environment that's out there, which isn't bad, but it's not necessarily good? I mean, what's sort of the advice that you would give them?
Well, I tell them, the same statement I made earlier, that I've not seen deals this negotiable in a decade. So, and all the fundamental reasons we just discussed in terms of why it's a great time to buy. The problem is that everybody is predicting the future, right? And everybody thinks that prices are going to come down further. Nobody can predict the bottom. And the thing I always tell clients is that you won't be able to predict the bottom. You should decide to purchase when you feel that the time is good. You're not, if you buy at 90% of the bottom or, whatever the case may be, you're still winning in the long run.
All right, Fannie and Freddie likely to come out of conservatorship this year. Will that have a material impact on the residential housing market?
It definitely will, because we don't know what their guidelines are going to look like once they're privatized again. Are they going to become, God forbid we see the lending that took place during the subprime lending crisis. I don't think we'll ever see that. But are they going to become more stringent or less stringent? And also, too, in terms of coming out of conservatorship, one of Trump's policies going into next year is potentially to reduce their ability to lend to affordable housing. How's that going to affect the multifamily market where, the credit to affordable housing declines?
All right, so a lot of open-ended questions there. Our thanks to Pierre Debbas. He is managing partner of Romer Debbas. Now, we have some headlines crossing.